Am I buying Amazon stock? Amazon is down by over 50% from its all-time high price, but is the company a buy or not based on its business fundamentals and future prospects? Now I'll analyze their latest company results, and at the later end I'll make a potential investment return analysis. Stay tuned to find out the most valuable information. As always said with educational purposes, and it's not meant as financial advice. The most recent 20% single-day drop in the stock price of Amazon was due to their lack of good guidance over the upcoming last quarter of 2022. But before we get into that, let's discuss the latest data. During Q3 of 2022, the revenue increased by 15% compared to Q3 of 2021, going from 110 billion to 127 billion. This is extraordinary growth of the top line and something unseen in the business world to date. In 2020, Amazon started the year with $280 billion in revenue. Today, it has almost doubled that revenue, as the total last 12-month figure is 502 billion. This is unheard of in the business space, but in a short moment I'll discuss one potential issue. To break down the revenue growth even further, Amazon has three main business segments. It's North American-based e-commerce, it's international-based e-commerce, and AWS, which is its cloud service. The North American sales segment increased by 20% year-over-year to 78.8 billion. The international segment decreased year-over-year to 27.7 billion, while AWS increased its sales by 27% year-on-year to 20.5 billion. Amazon is a company which focuses on operating income as a metric to calculate how profitable the business is. This is quite distinct, as the company invests heavily back for growth, and actually it currently has no real bottom line, meaning it does not have solid net income. Just a quick side note, the difference between operating income and net income is huge. Operating income is revenue less any operating expenses, while the net income is operating income less any other operating expenses, such as interest and taxes, amortization and depreciation. Operating income decreased by 2.5 billion in the third quarter compared to 4.9 billion in the third quarter of 2021. The North America segment had operating losses of about 0.4 billion compared with operating income of 0.9 billion in the third quarter of 2021. The international segment had operating losses of 2.8 billion compared with operating losses of only 0.9 billion in third quarter of 2021. The AWS segment had operating income of 5.4 billion during this quarter, and during the last quarter of last year it was 4.9 billion. It is quite obvious the biggest cash cow business for Amazon is its AWS segment, which is the main funding vehicle for all of Amazon's expansionist policies. Net income decreased to 2.9 billion in the third quarter, but out of this 1.1 billion is not real bottom line gains, as it is coming not from business operations but from a valuation gain stemming from their Rivian investment, an EV company in which Amazon has a substantial share of 18%. The gain of 1.1 billion is a paper profit, and the same paper profit could have been a paper loss. So the actual bottom line is 1.8 billion. Andy Jassy, the CEO of Amazon, stated, "What won't change is our crazy focus on the customer experience." This reiterates the goal of Amazon not to focus on the bottom line, but to invest everything in for top-line revenue growth and bring in more customers. Amazon is a pioneer in the model give, and at some point far in the future, they shall take. Sooner or later their model will change and their focus will turn to printing money instead of investing all back into the business. On the provided chart taken from Statista, you can see the global market share for the whole e-commerce space. Amazon has a 13% share, with the global leader being Alibaba, which are the biggest players in the space in China. Pinduoduo is a company in which I find a great interest in, as well as in Alibaba, so subscribe to the channel as I plan to upload a lot more analysis for a lot more good quality businesses. According to Global Newswire, the international e-commerce space will grow by 14.3% annually until 2030, which is quite the growth rate, and it provides very good business fundamentals. As far as Amazon's market share in the US alone, they are quite the leader. Amazon has a 37.8% market share as of June of 2022, while the second biggest competitor is Walmart with a mere 6.3% share. In order to have our full picture of Amazon's dominance, we need to take a look at their market share in their cash cow business, the cloud service. AWS is a global leader with a 40% market share, with the closest competitor being Microsoft Azure. Make sure to watch my analysis video on Microsoft, as well as I have analysis here on the channel for all other big tech stocks. The cloud segment, according to Global Newswire, is set to expand with a CAGR of 30% until at least 2028. CAGR is an acronym for Compounded Annual Growth Rate, and the latest one-year growth of AWS of 28% is in line with these assumptions. As for the reason why Amazon's stock most recently dropped by 20% in a single day, it is because of weak fourth quarter guidance. Net sales are expected to be between 140 and 148 billion, or to grow between 2 and 8% compared with the fourth quarter of 2021, while operating income is expected to be between 0 and 4 billion, compared with 3.5 billion in Q4 of 2021. Let's now make our fundamental analysis and look at the company from a closer look. Starting off with the short-term debt health of Amazon, they have a current ratio of 0.95. For this ratio, it is best to be above 1, as this will indicate the current assets are higher than the current liabilities. Current in this sense means they are due over the next 1 year. The long-term debt to equity, which shows a longer time frame picture of the debt levels, is sitting at 0.42. Below 0.5 is optimal, so here Amazon is doing a good job. Another good metric to look at when analyzing the debt security is the long-term debt to EBITDA ratio. Below 3 indicates an OK level. For Amazon, the ratio is 2.33. The current cash and cash equivalents of Amazon are sitting in at $58 billion, and the company can deploy this for new investments and better company management. When examining the efficiency of the business, which is the next pillar we look at, the ROIC and ROE are two metrics which we can use. And in the case of Amazon, as it is an e-commerce business, it is very good to check the asset turnover ratio and inventory turnover ratios. The ROIC is 3.24, while the ROE is 8.24. These are not great numbers. According to Buffett, we want both of these to be above a 12% return. The asset turnover ratio is calculated by dividing a company's sales by its total assets, while the inventory turnover ratio is calculated by dividing a company's costs of goods sold by its average inventory. The asset turnover ratio for Amazon is 1.2 over the past 1 year. It would be best for it to be above 2.5 for such a retail business, but below 1 is concerning. So according to this efficiency metric, Amazon is at OK levels. while the inventory turnover ratio, which looks at how efficiently a company is handling its inventory, is 7.25, which is quite high and a very good level. Above 4 is preferable. As far as the profitability and current valuation of Amazon in relation to its earnings, I think the company has some room to fall. The company currently does not make much net income, and this makes it quite hard to value it. A way we can value Amazon is to look at the future potential net margin the business could have and come up with a future fair value for the business. In the future, Amazon could potentially have a 10% net margin, but I want to be more conservative and I'll call it 7%. We take the current total revenue over the past 12 months of 502 billion, and from which a 7% net margin would give Amazon a net income of around 35 billion. To find out the market cap of the company in a somewhat near future, we must put a multiple on these earnings. If the company grows with around 10% per year going forward, which is not a small sum especially for the size of Amazon, then a justifiable PE would be about 25. The company also has an incredible moat which also deserves a higher PE, so 25 is pretty okay-ish to me in this sense. 25 times the 35 billion in potential future earnings gives us a total market cap of 875 billion. The current market cap is 920 billion, so it's almost at fair value. But if the company were to grow with 5%, not 10, a more normal PE would be 20, which would give the company a fair value of about $700 billion. I personally like to be more conservative as this lowers the risk and it could possibly increase the potential returns, and at around a price of 700 billion, I would be highly interested in the company, which is about 25% lower than today's prices. In general, this is a great business, but for it to be a great gem in my portfolio, I would need prices to go a bit lower. I hope today I earned your subscription to the channel. I have many more upcoming company analysis, so stay tuned. Comment down below what future topics you want me to cover next, and goodbye for now and until next time.